So for multifamily, for me, multifamily in particular, I like it because people need a place to live, right? Everybody's got to have a place to live, and they're going to continue to rent, whether the times are good or bad. They still have to have a place to live. Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hey, our sponsor for the show today is Pine Financial Group, the leader in hard money lending in Colorado and Minnesota, and they were recently approved to offer their investment publicly. This investment offer is only for investors in Colorado and Minnesota and is only made through their investment prospectus. Get your copy today. Simply visit www.pineinvestments.com and click to get started. Look, there's a reason why some of the wealthiest people in history invest in loans backed by real estate. Learn more about the risks and returns at www.pineinvestments.com. Hello and welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer, and we are excited for another Hump Day Hustle. I've got Matt Jones with me. Matt, how are you doing today?
I'm doing fantastic. How about yourself?
I'm doing very well. Anything new this week? Anything exciting or any mistakes you made that you've learned from?
Well, something I learned, a new way to adapt using lease options. You know, they're not just for small or like single family houses. You can use them for medium-sized multifamily properties as well. Like, for example, if you had a 50-unit place, you could lease option it to me, and I could pay a very low fee as a down payment. And then I would take over the running of the place, and then I would collect the rents, and then I would pay you rent less than that, and I would keep the extra money. And then in a few years, whatever the option limit is, if things are going well and I've saved up some money for a down payment, I could buy it at the price that we decided.
Yeah, so that's called a master lease option when you're doing it on a multifamily. And I did it on a 120 unit. I've got a friend that did it on a 168 unit. So it can be done on even decent sized multifamily properties or large multifamily properties. As the market gets hot, it's maybe a little more challenging, but everybody's got a reason for selling. If you're going to get those, it's obviously harder to do a lease option on a property that's been listed by a broker. But if you can find a true off-market deal, doing like a master lease option or contract for deed or any type of creative financing, definitely is plausible. Now, is it going to happen? Probably not. You're probably less than 5% of transactions are going to people are going to even consider something like that. But you give them the opportunity, you explain it to them, and that's definitely an option. I've done creative financing on fairly recently, since 2016, on 4 different multifamily buildings. So it can happen. It's out there, and it's something that you can use as part of your toolbox.
Yeah, very cool. And then how about yourself this past week? Anything new or lessons learned?
I think the biggest thing right now is just trying to maintain complete focus. And so one thing I did is, or I've been doing, is just writing down kind of everything I'm doing during the day. That way I can see where I'm wasting the most amount of my time and what I'm wasting my time on. That allows me to really, because I'm just writing down as I'm doing things, and it's like you start to really go, oh geez, I just spent 30 minutes on this, or 10 minutes on this, 10 minutes on that, 5 minutes on this, and it's like, wow, I'm wasting a lot of time. So I need to make sure I'm staying focused and not wasting that time. So I think that's the biggest thing is I've been reading The Compound Effect by Darren Hardy, it's a good book. It's really simple, but it's just concepts that we oftentimes don't think about. So that's the book I've been reading, and it just made me think about it. So been doing that, been writing down everything I eat, everything I've been doing during the day, and really trying to make sense of, okay, where am I going wrong during the day to where I can maximize my efficiency. So,
okay.
Cool.
Very cool.
Well, let's move on to today's topic. You want to introduce it for us?
Yeah, so we're today we're going to talk about large multifamily versus other kinds of commercial real estate, and sort of the benefits as well as the downfalls of how they compare with each other.
Awesome. Awesome. Yeah. So multifamily, and we're talking large multifamily. We're talking like 100+ unit buildings, where we can. I'll just start us off by some of the pros of the large multifamily, and then we can dive into some of the other asset classes. Maybe talk about some of the pros and cons of those. So for multifamily, for me, multifamily in particular, I like it because, well, people need a place to live, right? Everybody's got
Mhm.
to have a place to live, and they're going to continue to rent, whether the times are good or bad. They still have to have a place to live. There's other strategies like doubling up, like moving back with your parents and so on. But at the same time, we still need a place to live. So I always like that about it. That's a massive benefit. Obviously, we see what's going on right now with demographics. We've got people are kind of favoring renting more than in the previous couple decades. We're back to kind of levels that we saw decades and decades ago, as far as the tenant base. Back in like the 60s and 70s, we saw tenant base very similar to this. So, and I think that's a trend here to stay. The other thing I really like, obviously, is we're undersupplied still. Even as we build more and more, we're still undersupplied. We're at historically low vacancies. So that's definitely a huge benefit. The other thing is very stable, which, not only stable income, stable expenses, pretty stable market overall. So I definitely like that. Lots of opportunity for different value added strategies, lots of ways to make money, to cut expenses, to add amenities, to create value in different ways. So I like that about the space. Also, the large multifamily space, I like the fact that we can get really great lending terms, right? And something that most other commercial doesn't really offer is the types of lending terms that we can get in large multifamily. So we can get these 30-year amortizing loans fixed for, up to like 12 to 15 years, actually even fixed, even we can get 35-year HUD loan fixed for 35 years. So that's big benefit. We get these super low interest rates in the mid threes to low fours right now. Like I said, fixed for a long time, non-recourse, leveraged up to 80%. We have all kinds of different construction loan products, bridge loans, mezzanine debt. So there's just a ton of options for financing, and it's a very desirable product for lenders to finance. So that's a huge benefit. The other benefit is in the large multifamilies, I can have on-site leasing, I can have on-site maintenance. They get large enough, we have enough income where we can have on-site staff there taking care of the properties as well. And then we've got a plethora of third-party management companies in most major markets. Something that I don't see as much in other commercial assets. So those are some of the benefits, some of the reasons I favor it. There's definitely other benefits in other sectors, but that's some of the main reasons I like multifamily.
So I know for a lot of people, the 100 unit plus can seem intimidating, and in order for a multifamily to be considered commercial, it has to be at least 5 units. So why not invest like starting out in a smaller 5 to 75 unit place?
Yeah. So these 5 to 75 units, as you just asked about, there's definitely benefit to starting in that, because renting, you can start with your own money potentially, or maybe you and a couple partners, or it's just obviously easier to get that start. And I started with small properties too. I started with the 20 units, the 10 units, those types of properties. Actually, I started even smaller. I started with the 1 to 4 families. But some downsides to those. You you can't get the same type of financing that I talked about. Now, I shouldn't say you can't get that, but especially on the smaller ones like that 5-unit, 10-unit, they're a lot more challenging to get that type of financing that I was talking about, the non-recourse. Your loan amount has to be over $1 million. So purchase price oftentimes isn't quite enough. Now, as prices get more expensive, then yeah, does that happen? But for the most part, those really small are going to be challenging to get that beneficial financing on. So you're going to have to get recourse financing. You're going to have to get, the commercial type loan from a local bank, which is like a 20 to 25 year amortization, fixed for only about 3 to 7 years, maybe up to 10 years. If you get lucky. And like I said, it's full recourse, usually 25 to 30% down. The other big thing I think that's, you don't have that scale, right? So you get one vacancy that affects you a lot more. You get, bigger repair item that affects you more. And then the other thing is you don't have on-site. Okay. And that's one of the biggest things I like about the large properties. It's more professional. I get on-site management. If I get a 200 unit building, I've got 2 full-time people in the office and I've got 2 full-time maintenance people. Where if I have a 20 unit building, I have 0 full-time maintenance people and I have 0 full-time leasing staff on site. So those are probably the biggest downfalls. The other big downfall I would say is you got no amenities or very few. Like you can't put a pool in a 5-unit building. It just doesn't work.
Yeah, that makes sense. How about retail space? I see a lot of people really interested in triple net leases from, mini or like strip malls and things like that, or restaurants and such, auto parts stores.
Okay, so let's break that down because we've got different strategies there. So you've got the triple net lease, like you just mentioned, and you've got other options as well. So the triple net lease, let's talk like the Walgreens, the Dollar Tree, the CVS pharmacy, those types of ones. Those are a different strategy, right? That's called mailbox money. You stick your head in the mailbox and grab your check and you don't think about the property, right? That's kind of on the same level as I would consider investing in a multifamily syndication. Maybe a little bit more work because they are your properties. And if the vacancy does happen, you still have to deal with it. But those are going to be low cap rates, between, depending on your market, between, probably 4 to 6, 7 cap at the very highest. But most markets are right for the Walgreens are right around that 5 to 6 cap. And they're not going to have much value add, if any. They're probably not going to have any value add, quite frankly, because the Walgreens just has a super long lease, or these triple nets have a super long lease, so they're going to pay what they pay. So you don't have any value add per se. So that's probably your biggest downfall. The biggest benefit is you have very, very little maintenance, right? They take care of the property. They take care of all the bills. Repairs happen, they take care of it. So you do have some stuff you have to deal with, but very, very little. So that's a benefit of the retail space. Pretty stable, typically good, strong tenants. Now, when we're talking other retail, that's a totally different story. So your other retail might not be a triple net lease, or it might be a triple net lease, but it's not as strong of a tenant, right? You've got a newer business or maybe a partially seasoned business, but let's call it a strip mall, okay, that you've got. You maybe have a strong anchor tenant, but then you've got some other weaker tenants. You've got maybe a nail salon in there that's their first year or two in business, and you've got maybe a once upon a child store, or like who knows, just a small retail store that's not quite as strong. You might have a couple stronger anchor tenants, but for the most part in retail, you've got kind of a mix. So those are challenging. Obviously, we've got Amazon and all these other online things that are freaking out the retail space. That's still, I would say, up in the air. I mean, I think that industry is very new still. Even though it's been around, the online shopping's been around for a while. It's still fairly new. And when you look at demographics, I mean, who's the demographics that are taking over? It's going to be the millennials and the Gen whatever is younger than the millennials. They're Gen Z. They're kind of taking over, and baby boomers are starting to get older. I think they're even accepting a little bit more. But as that generation gets older and older and starts passing away, what's going to happen to retail stores? I think that's definitely concern to have. Now, do I think it's going to go away completely? No, I still don't think it's going to go away, but it's definitely a concern to have. I think if I was investing in retail shops, I would be looking to fill some of my occupancy with things like the nail salon, things like, chiropractor, maybe a small doctor's office, stuff like that, where they're actually, you can't go buy a back adjustment on Amazon. You can't do some of that stuff. So we want to look for some businesses like that we can fill in our retail space.
And how does retail perform, in a downturn economy?
Yeah, again, it's going to depend on kind of who you have as your tenants, your anchor tenants, and the majority of your tenants. If you have strong established businesses, probably going to perform pretty well. But if you have new young businesses, 9 out of 10 businesses fail within the first year. 9 out of 10 of those businesses fail in the next 10 years. So are you going to have some hiccups? Yeah. Are they really tough to fill during a downturn? Absolutely. So you've really got to look at your basis and where you're at and what's going to happen in a downturn and how much are you going to actually lose. You want to look at historical, what's happened in some of these recessions in the past and how much, what they're maybe at 95% now, but what were they during the last recession? Did it get down to 80% or 85% or what happens? You see these strip malls sometimes that are completely vacant or maybe have a couple of tenants in it and you go, holy cow, I'm so glad I don't own that thing. That's what makes me the most nervous about something like a retail space is, and you see a lot of them sitting there. But at the same time, there's potentially really good opportunities too, because they are sitting there oftentimes for a reason. Think about it. If you've got a business and it's reputable, do you want to be putting, and this compares to office as well, do you want to be putting your office or your business in a strip mall or in a office place, in any kind of building that's run down, that hasn't been maintained, that's maybe hasn't been updated since 1985? That's not what you want. Do you really want to be representing yourself like that? Most people, the answer is no. Like, I want my business to look professional. I looked at buying an office building and it hadn't been updated in years and years and years. And when you walk into the bathroom, it's like, this bathroom is nasty. It's gross. I couldn't have one of my clients come in and they asked to use a restroom. I would have to say, sorry, you've got to go drive somewhere else because you can't go to this bathroom. It's so gross. Like, you don't want that as your office. They walk in and it looks like something out of 1980. It's like, that's just not how I want to represent my business if I'm successful. So there is a lot of value add opportunities in some of these office spaces, some of these retail shop centers that haven't been updated in years because good businesses want to lease in good spaces.
Yeah, that makes sense.
Hey, let's take a minute to thank our sponsor, Pine Financial Group. Look, you work hard for your money. Is your money working hard for you? Because of inflation, money sitting idle erodes your wealth. Many investors understand that real estate is a great investment, but may not want the effort or the risk that comes with owning their own property. They want to sit back and have payments, hit their bank account each and every month. Stop eroding your wealth and start building it by asking your money to work for you. You should be earning profits while you sleep, an investment backed by real estate. Pine Financial Group, the leader in hard money lending in Colorado and Minnesota, was recently approved to offer their investment publicly. This investment offer is only for investors in Colorado and Minnesota and is only made through the investment prospectus. Get your copy today. Simply visit www.pineinvestments.com and click to get started. There's a reason why some of the wealthiest people in history invest in loans backed by real estate. Learn more about the risks and returns at www.pineinvestments.com. It's www.pineinvestments.com.
And how about mini storage units? I see a lot of these being built recently nationwide.
So, I mean, there's mini storage or self storage. You know, they kind of fall in the same uh, area, but so like the mini storage is going to be, you know, probably that heated storage, climate controlled storage, I should say.
Sure.
In Minnesota, it's heated, but it's climate control storage. It's typically you walk into a building, you might drive into the building, but it's kind of one main building. And then you've got the other ones that are more like garage styles. Those can be climate controlled as well. Definitely a lot of benefit there. The biggest concern with those is right now there's just an oversupply. There's been a ton of building. I think everybody thinks that everybody's going to own a bunch of crap they don't want to get rid of and just going to store it. And so there's a lot of building. And so you got to be really cautious about what market you're in and what the supply is. So that's the biggest concern in that industry is, you know, the profitability is great if you've got an occupied building or if you buy it right, but what's the vacancy rate? How much building is going on? How are the cities reacting right now? A lot of cities are putting kind of moratoriums on building new self-storage. So that's good. That's a good thing. If you are an owner of them, you want to make sure that you don't have a bunch of new construction happening because that's where your tenants are going to go. I like the industry overall. If you can find the right stable markets, and most markets aren't super oversupplied. It's just a handful that are very, very oversupplied. Then some other markets are kind of oversupplied, and then the rest of them are okay. But you know, they're good because you've got very little maintenance. You've got very little overhead. You've got very little tenant communication. It's just pretty easy to do. You got a lot of automation that you can put into them to where it cuts down even more on tenant communication. Now, I do think you still want tenant communication, but the more automation you can put in, for the most part, the better, as long as you do maintain a level of communication with your tenants. The thing I would be the most concerned about is I don't know about you, but people that I know that are my age and younger don't want a bunch of crap. Like, we don't want a bunch of crap. We don't own a self-storage place. Rent a self-storage place. We'll never rent a self-storage place. I don't know anybody that's my age, quite frankly, that rents a self-storage place and accumulates that much stuff. I think most people my age and younger seem like they don't accumulate that much stuff. I don't know about you, but that's been my experience. What's yours?
Yeah, I know a few people who have, just as a transition basis, if they're moving or upsizing or downsizing. That's different, I guess. That's a short term. Yeah. But as a long term, I mean, you know, I've seen the shows, so it's interesting what people store in there. But I don't know people specifically who store stuff. I just keep my stuff in my garage or basement or whatever.
I mean, everybody that I know right now that has self-storage, I mean, I'm picturing them right now. They're all in their like 50s and 60s and 70s. So that in my opinion would be concerned. Now that's just my experience. That doesn't mean that's a validated research product, right? I didn't research this. This is just something off like my head with my experience. So it might be different. I would have to really dig into it if I was interested in that industry, which I am. But if I was going to be seriously consider purchasing something, I'd want to look at that demographic and see what's happening, see who my tenant base is, and when they're coming in. And obviously people still like their crap. I'm not saying they don't, but once the baby boomers again die off, what's going to happen if people don't have as much stuff and they don't want to store it at self-storage places? Well, then these self-storage places are oversupplied. Yeah. So something to just be aware of as you're looking at stuff is you always want to look at what the demand is. So,
and what the demand will be too.
What the demand will be, yeah. By the way, going back to retail, office, and this actually applies to like industrial and some of the other things that we're going to talk about. One of the nicest things I think with these industries are you are dealing with business owners, right? So we always talk about surrounding ourselves with successful people, surrounding ourselves with like-minded people. Well, guess what? If you have tenants that are business owners, you're surrounding yourself with like-minded people. You're surrounding yourself with successful people. You get to talk with business owners every day. that as your tenant. If you've got apartments or self-storage, our typical apartment tenant is going to be B and C class tenant. We have A class? Yeah. But for me, especially, most of our product is B and C class. And so that's the tenant that we're going to be communicating with. So and not that there's anything wrong with those people. I'm not saying there's anything wrong with those people, but when we talk about who we associate with, we're associating with people that typically aren't business owners, typically aren't, not saying not successful, but successful in business and in, that type of industry, and having the same mindset is what we want. Your typical B and C class are W-2 and they're working full-time jobs and they're, normal everyday people. They're potentially fantastic people, but they're just not those business owners, those entrepreneur mindset, that type of thing.
Yeah, that makes sense.
So I think that's a big benefit of the retail, the office, the industrial. Some of those are that you get to deal with those types of tenants. Now there can be some downfalls with those types of people, but there's, I think, overall benefit.
Okay. And what are the pros and cons for hospitality? And I'm talking hotels, motels, resorts. I know you used to own a ski resort.
Yeah, I mean, so obviously the biggest downfall I would say is it's very economy driven. Times are good. People want a vacation. They've got extra money. They want to go on vacation. They want to spend their money. They want to go to your resort. They want to go to your ski resort. They want to go to your RV park, whatever it is. So yeah, times are great. They want to spend. They want to be there. They're going to spend extra money on all the extra little amenities or, restaurants or whatever else is there that you might have. Times are bad. People cut back. They don't want to go on vacations anymore. They don't want to spend that extra money. They're not going to go on 3 trips a year or 2 trips a year. They're going to go maybe on 1, or maybe they'll go every other year. Just skip this year because, they're not quite sure about things. So I think it's very volatile on the economy. Now, all of them are volatile on the economy, but hospitality and tourism tends to be even more volatile on the economy than any other one of those goes. So you just really have to be looking when you're buying those properties at what your vacancy rates are and what they tend to shift to. And every market's going to be different. Things out in the country are going to be different than places in the city, than places in really touristy areas. If you're going to buy a hotel that caters mainly to businesses, to business travelers, you're probably going to be pretty well insulated. Right. But if you own a resort or a hotel that's in a resort type area, well, you're not going to be very well insulated at all. So you've got to look at, okay, what's my downside risks to this? And does this building make sense in a poor economy?
Yeah.
So especially when you're buying in a good economy, that's the one thing in any asset class right now that we got to be really aware of, whether it's office, retail, multifamily, self-storage, hotel tourism. We're in a good economy right now. So if you're basing all your numbers on what's happening today, and that's kind of what you're looking at, well, a recession eventually will happen. And so we have to understand what can happen and what our downside potential is. And if we can understand that and we really process and think about it and our property still works, well, then we're insulated and it's worth buying. But a lot of people don't think that way. They go, oh, it's good right now. It's 95%. They just don't think about the downside risks.
Yeah, that's where conservative underwriting comes into play, where you're, even in the bad times, if you're still going to be profitable, then it's probably a good deal.
Yeah, and we can never predict 100%, what's going to happen, but we want to be aware of what has happened in the past and be able to stress test our properties. In my underwriting, I've got a tab that is called stress testing. And we do several stress tests on that tab in order to see if our properties make sense to do, to purchase, not only right now, but in potential bad times.
Sure. And then what about industrial, like light assembly and factories, that kind of stuff?
Yeah, so obviously industrial is broken into several, like you just kind of mentioned. You've got, and I would call warehouse part of industrial as well. I mean, you've got the warehouse, you've got light industrial, and then you've got heavy industrial. Mostly heavy industrial is owned by the business typically. It's a larger business like 3M or something like that. They're going to own their own building typically. But then you've got a lot of light industrial, you got a lot of manufacturing plants and stuff like that. And then you've got your warehouse, which is like your Amazon, storage and whatever. So those, right now it's a very hot sector. I would say it's as hot as multifamily. I mean, people love it. People are seeing a lot of benefits to it. One of the I guess scariest parts about industrial, especially, it feels like as you get into the bigger units, I think one of the biggest risks with industrial, and I would say this to anything, the office to retail, is if we have one or two tenants, there's a lot of risk there, because what happens if that tenant goes out of business, So I think that's the biggest risk in industrial, and quite frankly, in any of the sectors, is if you have just one tenant. And you don't have a bunch of them. So I like the industrial that's kind of got the bays, where you have 5, 6, 7 different businesses in there. So if one of them goes away, you still have the other one supporting you. I like the mullet of real estate, where you've got the office in the front and the warehouse in the back. That's the sector I would be the most interested in purchasing. But industrial right now has extremely low cap rates comparatively. I think historically or not historically, but I think right now in the U.S., they're averaging in the 5% range for cap rates. Very similar to multifamily, high fives.
What is it about those mullets that you really like?
You've got the versatility. I mean, and you've got, you kind of got the best of both, right? You've got the office. A lot of people want an office there, and they have businesses that they want the presence, they want the storefront, they want the office, they have the admin, but they also need, the storage or the manufacturing or whatever it is. So I just think they offer that flexibility. Those flex spaces, I think, are really nice. So I think they give a lot of good options to business owners.
Yeah. Do those tenants tend to stay longer?
Yeah. So your businesses overall tend to stay, but I would say, your industrial, it's expensive to move. I mean, it depends on what it is, but let's think about a manufacturing company. It's expensive to pick up all your equipment and move it. It's going to cost thousands and thousands and thousands of dollars to move all those machines. And you probably retrofitted the building to work really well for your purpose. You might have had to put in air handlers. You might have had to, done a lot of different OSHA regulations in order to make that facility compliant to your special purpose, your special need. I mean, the more specialized, the longer you're probably going to stay. If you've got medical and different types of manufacturing, I mean, man, the chemical manufacturing, I mean, you've got to have all kinds of different things that you put in place in order to make it compliant. And if you're going to move, it's going to cost you a lot of money. And so they're going to be really careful and really slow at moving. They can be very, very stable. The bad thing is they specialize that. And so now all of a sudden you're kind of, you either have to do a new build out, or if they move, you have to do a new build out, or you have to find a business that's very like the business that just moved out. So.
And then there's another class called special use, and that includes a variety of things. That could be religious facilities, gyms, event centers, that sort of stuff. What are your thoughts about special use?
Yeah, I mean, they can be great. I think for the most part, if I were buying those, I'd want to be the one actually running the business out of them, but that's just me. Medical, obviously really strong. You could consider that part of the office sector as well, or special use, but very, very strong medical. So yeah, I would love to buy something in the medical, but those are very low cap rates right now. Very attractive for people to purchase, and kind of a lot of mailbox money in those because they've got long leases, and those, again, they're probably going to stay for a while, especially if you've got more specialists in your medical center.
Yeah.
So I'm not super up on that field, so I don't want to go too much in detail on it.
That's fair. And then there's a mixed use where it could be retail space on the first floor and then apartments above it, or any other mix of any of those classes.
Yeah, so mixed use is can be great depending on where you're at. So you got that retail, you got the restaurants, you got the bars, whatever on the bottom floor. You got apartments on the top. The one thing to be cognizant of is your financing. I don't know the exact ratio right now on top of my head. I think it's 85-15, but don't quote me on that. If 85% of it is apartments and 15% is retail, you can still get agency debt, Fannie Mae, Freddie Mac, the loans I talked about right away, where we get 30-year non-recourse. But if it's over that 85-15, again, I don't know if that number is the actual number. So again, don't quote me. Get some, have a conversation with a commercial real estate broker, like a Greystar or a Arbor or, somebody like that. But if it's over that, you're going to have to get kind of more of your traditional commercial, where you're going to, local bank or regional bank, or and getting your 20, 25-year AM full recourse or partial recourse. You're getting your 5-year fixed, that type of debt. Maybe interest rates are probably closer to that 5%. So a little bit different in there, but at the same time, that's great product. It gives you not only some of the professional tenants that you're looking for, but it gives you some of the stability of the multifamily. So, and then it gives your tenants some amenities that they don't have to go anywhere. They already got the restaurants, they already got some retail, and they love it. So those are really great for urban core investments. Definitely like those a lot.
So in the beginning of this episode, you kind of talked about some of the positives of large multifamily. What sort of advice would you give to people to make sure, when they are getting large multifamily, to make sure they're set up for success?
Oh boy. I mean, that's a big question. We don't have time to answer that really. There's so many things involved. I think, there's a lot of different episodes that we've already talked about some of the different things, and we could dig into it. But I think overall, it starts with your underwriting. Are you being conservative with your numbers? Are you being realistic? Are you stress testing? And then the next is operations. Do you have the right people in place to operate the asset? And this goes for all asset classes, not just multifamily. This goes for every commercial asset class that we've talked about today. Do you have the right people in place to operate the asset? Do you understand? Do you have a clear-cut business plan, understand what your goals and objectives are, and then do you conservatively underwrite the asset and have the right amount of reserves and financing in place?
Yeah. And so there's so many different ways of investing in real estate. And I think a lot of people can become victim of the shiny object syndrome. What advice do you have to people on considering all these different ways of how they can narrow it down to the one best way for them?
Yeah, pick one. Simple. Pick one. I mean, pick a strategy you're going to do. It doesn't have to be multifamily just because I like it. Doesn't have to be it. I do like other asset classes, quite frankly. I do like the idea of a little bit of diversification, but I wouldn't go crazy on your diversification and think you're going to buy a little bit of everything. At least not right away. I would slowly be doing that. So if you want to transition into here's one thing I would say is pick one, stick to it, do it really well, get the right assets, be strong at it, make money at it. If you want to switch into another asset class, either do it two ways. One, find partners that are very well versed in it and partner with them. Okay. Figure out how you're going to fit into their business and get some sort of control over it, whether it's bringing money to the table, bringing some of your other skills, maybe your underwriting skills, maybe your management skills, whatever it is, but partner with the right people. The other way is I would wait for the economy to be bad. And once the economy is bad, that's the time when the economy's at the low end. That's the time to start digging into new asset classes and looking into them, because that's where you've got the most amount of forgiveness. Right now, you don't have a lot of forgiveness. If things go bad on your asset and the economy goes bad, you're going to go down with it. There's not a lot of room for forgiveness, where if you got a little bit of a poor economy, and you can buy it at a really good value, there's a little bit of room for forgiveness. So I would say, yeah, shiny objects, great, but let's actually focus on something.
Yeah, that's fair. Any other thoughts about large multifamily versus the other commercial real estate classes?
No, I think I've covered it. As far as my opinion, I think I've covered it all.
All right, fantastic.
Cool, Matt. Well, that's all I got. You got anything else you want to add?
No, that's it for today.
Okay, perfect. Well, you have a fantastic rest of the day. Make every day Saturday. Hey, thanks for listening to the show. Couple things before we go. Again, go on to our Facebook page, Pillars of Wealth. We'd love to have you on there. Go on to iTunes, give us a rating and review, and subscribe to the show. Also, don't forget, reach out to me if you want any help with potentially growing your business, and reach out to John Stiles to help you buy or sell real estate. Thanks for listening. We appreciate it. Have a fantastic the rest of the day. And as I say, make every day a Saturday.